Hi, this is Laura Ciceri with Supply Chain Insights. We will be getting started in about 1 minute. Have a cup of coffee, relax, and we'll be getting started in a couple of minutes. We have a high volume of people that are getting on the line right now. Thank you. Hi, this is Laura Ciceri, founder of Supply Chain Insights. Welcome to our webinar on the Supply Chain Index. Today we're going to look at consumer value networks and how do you measure up. So with that, let's start our webinar. I want to be sure that you know that all of the slides that we will show you today on the webinar will be available on SlideShare. It is our policy that when you give to us, we give to you, and all of our research is available in front of the firewall, and we share widely. For those of you who are following us on Twitter, please tweet with SCI Webinar and let us know your thoughts. We are still in the evolution of the Supply Chain Index. It's taken us 3 years to really make the progression of where we are today. And we want to hear from you to understand your perspective and to also get your insights. All of the questions that we receive in the live chat panel, we will be answering as we go along in this particular presentation. So at Supply Chain Insights, we have been working on the Supply Chain Index since we started 2 years ago. It is our goal to be independent, actionable, and drive objective advice for supply chain leaders. We write for supply chain leaders, and we fund the research for supply chain leaders. So the research that you're going to see today was funded by Supply Chain Insights. It's designed to be objective and actionable, and designed to help supply chain leaders to be able to drive a higher level of insights about what they're doing. So when we think about supply chain excellence, we think about improving balance sheet performance. And when I started this work, I was a bit naive. I thought that we could see the impact of technologies and processes on corporate performance. And I was a bit naive, and I reached out and I recruited Abby Mayer. Abby, how are you doing today? Good. And Abby is the brain behind the Supply Chain Index. We sit on 20 years of supply chain financial ratios, and I actually recruited Abby as an MBA student to try to help me to look at corporate performance over the last 30 years of supply chain. And she started out looking at the data manually and getting corporate performance data, and we found that it was a pretty big task, and we found that the relationships were not linear. And, we stubbed our toes a couple of times and decided that we needed somebody with greater math capabilities. So we hired Dr. Runger at Arizona State University and his team to help us with some higher math to apply to our orbit charts. How are you doing this morning, Dr. Runger? Sounds like he's still dialing in. So our vision was to develop a methodology to help supply chain leaders measure supply chain improvement. Unlike other methodologies, this methodology is not to answer the question of who does it best, but it's to really measure supply chain improvement. And what you're going to see is that companies that are good actually improve at a slower rate than companies that aren't as good. It's sort of like the Biggest Loser, the guy that's 400 pounds that hops on the scale can make greater progress on the show. But what we wanted to do was to be able to develop a methodology that would help supply chain leaders to know how are they doing over time by peer group. Are they driving improvement? We wanted it to be objective and data-driven. We wanted to compare companies across currencies. And we wanted to enable the comparison of progress of companies irregardless of size, very large to mid-market companies, because many companies are out there working and they want to know, am I making improvement? And how is my rate of change comparing to other companies? We also wanted to change the dialogue. I hear a lot of discussions around best practices, but I don't think we know what best practices are until we can connect the choices and technologies and processes to corporate performance, and that was our goal. And we wanted to use standard and available data, because when we look at supply chains today and we ask people for, how they describe supply chains, overwhelmingly people will say there's room for improvement, but they don't know what to do. And the other thing is we find that it is an increasing risk to not actually have a supply chain that can manage global operations or be able to flex with increasing demand volatility. So what we wanted to do was we wanted to understand where are we with this thing called supply chain, because the supply chain is a complex system with complex processes with increasing complexity. And we knew this going in, that it was a complex system. We didn't realize how complex the system was and the fact that it was nonlinear, not a linear system. And so we started our journey to look at how could we be able to characterize corporate performance of companies that was resilient and predictable, that was balanced across a set of metrics, and could show year-over-year improvement. In my first book, Bricks Matter, I started with this model, as all of our research projects start with a model. And I wanted to know which companies had optimized profitable growth with the trade-offs of revenue and cost of goods, and then been able to tie the process to working capital and to be able to make the trade-offs of corporate social responsibility while managing the trade-offs of asset strategies. Now, underneath that, we've got to trade off forecast accuracy and customer service and inventory. But one of the things that I found in being able to do this is a lot of times companies will improve forecast accuracy, but they don't use it. And our numbers for forecast accuracy and customer service are not very good in the industry. In fact, I can't find a source of consistent and accurate data that goes across the wide company range that I'm looking for forecast accuracy or case fill or corporate social responsibility. And so one of the issues that we have is we may have self-reported data for forecast accuracy or case fill, but we tend to overstate it, and there's a high bias that most companies report on forecast accuracy and case fill. And there's not a good standard definition for forecast accuracy and case fill, nor is there a good standard definition for corporate social responsibility. So we abandoned our first model and we developed the second model. And on the second model, which we call the supply chain effective frontier, what we wanted to understand was how had companies made improvement on growth, profitability, cycles, and complexity. And we spent 2 years socializing this model and talking to supply chain leaders about how we pull supply chain up to just not be a function, but to really be a catalyst to drive alignment around metrics. And one of the things we found was that increasing complexity in organizations was actually causing a lot of companies to stall, and we found that 9 out of 10 companies were stuck at the intersection of inventory turns and operating margins. And while a lot of companies talk about best practices, they don't realize that they're stuck. And the other thing we found was that these relationships are not linear, they're very complex. We wanted to look at value networks. So when we look at value networks, we're looking across a group of industries and we're looking at what are the progressions. So for the period of 2006 to 2012, just to level set you before we give the data, these are the average operating margins, the average inventory turns, the average year-over-year growth, and the average revenue per employee. Now, what we have found is that most companies, 99%, have improved revenue per employee. So they've made the organization more efficient. But what we also find is that they are not able to sustain progress at the intersection of inventory turns and operating margin. They may do a project, and that project may have short-term results in that area, but over time we see that the ability to drive progress at the intersection of metrics is problematic. This is research that we did last year that looks at the intersection of industries and asks the question, how many companies within an industry have made progress at the intersection of inventory turns and operating margin? And you can see that initially companies do well and then they fall off. But in a recession, companies will get more serious and the progress becomes better. And a lot of this comes with rationalization of complexity or more targeted programs or perhaps better cross-functional horizontal processes. So Abby, tell us about the history of our work from your perspective.
As Laura mentioned, we started about 2.5 years ago, and what we first started with was just mining financial data, and that was a very manual, slow process in terms of logging on to investor relations websites, finding the right metrics, pulling them, or finding the right raw data, pulling that data, getting it organized, and then coming up with the metrics. And what we have access to now is a database of about 20 years of financial data, and you can see in this table how we've sorted that into those 4 categories of growth, profitability, cycle, and complexity.
So Abby, the ones in the boxes are the ones that we finally decided on for the index. Tell us a little bit about how we came up with this.
Yep. Revenue revenue growth is the metric we like to use to represent growth. That's obviously, universally important across industries. Operating margin, inventory turns are metrics that really matter within the supply chain function, and so that's how we settled upon those. And then finally, return on invested capital. That's probably the least familiar metric for most folks. We shied away from return on assets because we didn't really find a pattern or strong relationships in some of the analysis we've done over the past 2 years. And we settled on return on invested capital because it better captured the complexity within modern supply chains.
So Abby, one of the things we did on the selection was look at correlations to market capitalization. Tell the group how we did this work.
Right. Last summer we were involved in a research project to look at market capitalization, how that related to the list of about 15 metrics you see on the left-hand side of your screen. And so we were doing this based upon Morningstar sector, trying to understand which metrics correlated to changes in market capitalization.
And this is where we actually aligned on inventory turns and return on invested capital. And one of the things that I learned, Abby, from working with you is this technique called orbit charts and how companies move over time at the intersection of these metrics. Walk us through how to read an orbit chart.
Yeah, an orbit chart, so this is sort of prior to the index analysis that we're going to talk about today. We were using a lot of graphical analysis, pattern recognition, and so this is an orbit chart you'll see on the screen. We have 2 metrics. We have inventory turns on the y-axis and revenue per employee on the x-axis, and you'll see a pattern. This is Dow Chemical Company, and I've marked where they started in 2002 and where they ended up in 2012. A couple other things to note. As you're tracing that pattern, you can see the best scenario in that upper right-hand corner. And so this is just an easy way to get a sense of we want to be maximizing inventory turns and we want to be maximizing revenue per employee. The other thing to note is the diamond, and then you'll see that box with a couple numbers in it. So this shows the average over that period. So over the period of 2002 to 2012, Dow had an average $999,000 revenue per employee performance, and 6.7 was the average inventory turn performance.
So this is very characteristic, Abby, of what we found was, companies aren't making linear results. And so, we published a series of reports. Tell the group a little bit about this, and then we'll get into the index results themselves.
Definitely. Over the past 2 years, we've published about 20 reports. These look at industries on an individual basis and using the orbit charts, using the financial metrics to try to understand what specific metrics matter, what patterns we're seeing within those particular industries.
And these are all available on SlideShare. So as companies go through the work we're going to talk about today, they can go back. Now, I met Dr. Runger at the Informs conference, and I said to him, I wanted to be able to measure the tightness of the pattern and the orbit chart at the intersection of operating margin and inventory turns. And this is one of the first projects that we actually worked on with Arizona State University, was plotting the orbit charts and looking at the tightness of the patterns. And Dr. Runger and his team came back and said the most effective method to do this was to look at the mean distance to points of selected companies. And so in our database, which is all publicly held companies, we looked at what was the resiliency for a time period. And this is actually from the period of 2000 to 2013. We see that companies were more resilient at the beginning of the decade, and then we've had some greater issues with resiliency in certain industries like consumer electronics, high-tech and electronics, contract packing, and third-party logistics over the course of the decade. So, Abby, let's get into the index, because the index is a way that we bring this together. Basically, we measure the balance of how companies have done at the intersection of return on invested capital and revenue growth per year. We call that balance, and that is calculated on a proportional difference vector trajectory to look at a time period. And today we're going to show you 2006 to 2012 and 2009 to 2012. So you can see which companies are making progress at that intersection of the effective frontier. We're also going to show you the intersection of inventory turns and operating margin, and that will rank for 30%. And again, it's a vector trajectory. And resiliency, we're looking at how tight is the pattern. We believe that the best supply chains are balanced, they drive growth, they maximize asset utilization, they're strong, they drive improvement at the intersection of inventory turns and operating margin, they're resilient and reliable, and we will ask the supply chain shaman circle to actually give us peer rankings by industry for 10% of the score in the August period when we finish all of this analysis. The index framework will look at each industry, which is a NAICS code, will give a balance factor of how well that company did in the time period at the intersection of growth and return on invested capital, and then we'll stack rank them one to the end of the list. Strength, which is the intersection of operating margin and inventory turns, each company gets a factor, and we stack rank it. Resiliency, which is the tightness of the pattern, and then we stack rank it, and then we'll ask for peer feedback. And again, balance counts for 30%, strength counts for 30%, resiliency counts for 30%, and right now peer ranking will count for 10. However, we will be asking the shaman circle to say, do we have the right weighting between these factors, and what is the right time period? And I want to sensitize you to these two questions today as we go through the data. And the Shaman Circle is an exclusive invitation-only group of senior supply chain leaders that we basically have an informal networking opportunity for, and we will be asking them to give us the answers to these questions, and we'll publish the final rankings at our conference in September. So let's take a look at the Consumer Value Network. Here's retail. This is the period of time for 2006 to 2012. So you can look at the stack rankings. The first column is revenue in billions for 2012. The balance ranking. So if you're negative, you are not making progress at that intersection. The more positive you are, the more progress that you can make. So you can see Sainsbury actually had the best ranking here on balance. Strengths, which is at the intersection of operating margin and inventory turns, you can see that, again, Sainsbury ranked very highly there. Resiliency, which was how reliable was that pattern, they didn't rank so high on. And then you can see the absolute rankings of how that stacks up. And Dollar General doesn't score the best in any of those rankings, but on average, they are balanced across the three. Abby, anything you want to comment on here?
Yeah, I think it's important here to look at those resiliency values. And so the best company, Kohl's, has that very low value at 0.1. And then there's a range all the way up to 3.8, which is Tesco, and that's a very large range of resiliency. If you look at the other industries, there's much less variety in those resiliency numbers.
Okay. Now, you know, these are off the orbit charts, which we will publish. This just gives you an idea of what these perspectives look like underneath the covers. So, you know, as you look at Target, Target is less resilient, but they're stronger, particularly in the latter period. And here is CVS and Walgreens. You know, you can see that these are not linear relationships. You know, we were very naive when we started this work. And the averages represent the average over time. But of course, companies make progress at different rankings and rates. And so when we compare a different time period, which is 2009 to 2012, we can see that the retailers start to shift them. Abby, what do you see in this data?
Yeah, I think you can see that, you know, Dollar General is still coming in at the top, and they've actually performed #1 in both balance and strength, which is something different than we saw in that longer-term perspective from 2006.
And, you know, I think it's interesting that Target is moving up the ranks here, and, you know, CVS is outperforming Walgreens. And, you know, some of the impact of new store formats, I think, are being seen here. And then look at how much Sainsbury falls, you know, on the rankings. Any insights here?
Yeah, I think, again, if you look at that resiliency number for Sainsbury, that's, you know, almost 5, and that's just really a very loose, sort of chaotic pattern between inventory turns and operating margin.
Really driven by a number of projects that perhaps they wish they had rethought, right? So in summary, in retail, the drug channel rises in the rankings. Kroger and Target make progress. Sainsbury and Costco fall when we look at the different time periods. Now let's take consumer packaged goods. So Abby, we spent a lot of time talking about what is a consumer packaged goods company and what is food and beverage. So let's just be sure we have the right definitions here. What did it mean to be in a CPG ranking?
So we really tried to negotiate that line in terms of raw materials and if they were dependent on sort of the food and beverage raw commodities versus more household products portfolio.
Okay, so when we look at consumer products in 2006 to 2012, you can see that the beauty category is rising in the ability, particularly to drive balance. And Colgate-Palmolive, of the more traditional CPG, will rank the highest in 2006 to 2012. Abby, what do you see in these numbers?
Yeah, I think one of the most surprising things within this peer group is how low Procter & Gamble ranks, and so you can see them down ranked at number 15, which was very surprising and unexpected to me.
Yeah, and you know, when we look at Procter, so if we look at Procter versus Colgate at the intersection, you can see that Colgate-Palmolive is outperforming Procter on operating margin, and Procter & Gamble has really focused more on inventory turns. And the progress was faster at the beginning of the decade, and if you compare it to Unilever, on average for the longer period, Procter did better, but Unilever has eclipsed their progress in the short term, and that loss of operating margin, which I attribute to complexity and focus, is causing them to lose ground on the index. When we compare a shorter time period, 2009 to 2012, and we look at improvement, Abby, what do you see here?
Yeah, one of the things I noticed looking at this table is Colgate is still ranked #1 in terms of resiliency, but they've fallen down the chart. And so I think it's interesting to see sometimes companies will do better over a longer time period, or they'll do better over a shorter time period. So that's ongoing research in terms of understanding that.
Yeah, and they actually lost 10 days of inventory to Procter & Gamble, Colgate did. One of my favorite stories is the Beiersdorf story of how Daniel Weber really focused on that balance in his podcast. It's fun to see Daniel's company rise here. And it's also fun to see some of the work that Pierre Luigi's doing at Unilever making progress. Abby, any other thoughts here?
Yeah, the other thing I notice is if you look at the balance values, nearly every company has negative performance over that shortened time period, meaning, you know, overall they were losing ground on ROIC and year over that 4-year time period.
A lot has been happening in this industry, for sure. So overall, beauty gains ground, easier to drive revenue year-over-year growth, easier to drive return on invested capital. Heavier CPG, things with water, lose ground as the cost of transportation increases. L'Oreal, Beiersdorf, and Unilever improve. Colgate falls. And, you know, here we have it. Now let's look at food and beverage. Very different dynamic in this particular industry. What do you see here, Abby?
Yeah, I think within food and beverage you can see a mix of revenue size, and so there's no overlying pattern in terms of larger companies are doing better or smaller companies are doing better. That was a pattern we're looking for that I don't really see within food and beverage at this point.
So we don't see economy of scale. In fact, this is one industry that sort of negates the traditional thinking of economy of scale. But what I find very interesting is the Hershey story. I was actually talking to the Hershey team yesterday, trying to get them to speak at my global conference, and I'm not sure I'm going to twist their arm. But look at the progress that the Hershey team made post-recession on operating margin and inventory turns. And they're penalized a little bit by the history of lack of resilience, but great progress. And then the Campbell's team, a very tight pattern in a tough market where we have rising commodity prices. And then if we look at General Mills and Kellogg's, the cereal category is getting hit very hard on commodities, very hard to regain the ground here. But overall, General Mills is doing better than Kellogg, and I think it's a great story of really wonderful network design, planning, cross-functional alignment over Kellogg. And what we see in the index is when we compare peer groups, we're seeing that supply chain excellence matters. Now, when we look at the shorter period, we still see Campbell's and Hershey at the top, but we see Nestle and Smucker's rising, and we see that PepsiCo is actually rising above Coca-Cola. Thoughts here, Abby?
Yeah, I think within food and beverage you can often look at really similar companies. So I know you mentioned Pepsi and Coke. You can also compare Kellogg and General Mills and get a sense of, you know, companies that have very similar business units or characteristics that they're operating in and how that varies.
You know, and that's one of the beauties, I think, of the supply chain index, because it allows us to change the peer groups to look at relative rankings. For example, is J&J a pharmaceutical company or a consumer products company? Is Bayer, a pharmaceutical company, or a chemical company. So different companies want to actually stack rank performance against different peer groups and different time periods, and this allows us to do it. So in general, if we look at food and beverage, a tough industry being hit very hard on operating margin. Nestle, Smuckers, PepsiCo, InBev rise. ConAgra makes significant gains. General Mills and Coca-Cola Enterprises fall. And what we're seeing here is sharing of downstream data, planning, the ability to drive horizontal processes make a difference. Chemical, let's look at this. Abby, what do you see in the chemical industry?
Yeah, I see within the chemical industry there's a little bit more that I see in terms of the economies of scale, which we touched on earlier. And there's also, there's no company that is #1 across all three categories, so I think that's important to see. There's also companies that are faltering on all three categories, and so I think, focusing on one of those three sometimes has unintended positive consequences on the other two in terms of performance.
Yeah, we definitely throw the supply chain out of balance, right? So, if we look at the patterns, right, and, this is DuPont versus BASF, you can see that BASF has a much tighter pattern and is actually driving higher inventory turns when we look at the period of 2000 to 2012. And Dow Chemical is actually an outlier in revenue per employee, but it struggled for balance in that 2006 to 2012 time frame. But, when we change and we look at a more recent time frame, we see a little bit different story. What do you see here, Abby?
Yeah, the most shocking thing in this table is how significantly Dow has moved up in the rankings. So they came in right at the bottom of the table over that longer time period, and here they're coming in tied for third with BASF and Westlake. So I think that's an opportunity to try to understand, what happened in this more recent time period that was so different from that longer term perspective that had that radical change in their results.
Yeah, the merger and acquisition activity with Roman Haas affected Dow, and a lot of the stuff that happened with K-Dow. But BASF, I think, is really making impressive strides here. When you look at the size of BASF and their ability to have balance. And, Monsanto isn't making much progress on strength, but they're certainly making progress on balance and resiliency. Anything else here, Abby?
Yeah, I think, looking at Monsanto is a good example of a company where they've really got the balance figured out, and so then it comes to, how do we keep that in line and move into these other metrics that we should also be watching and improving.
So, in the chemical industry, we see BASF and Dow moving up the stack. DuPont, FMC, and Ecolabs dropped in the rankings. And then let's finish with Apparel. So when we look at 2006 to 2012 and Apparel, Abby, what do you see here?
Yeah, I think in this table, what I see is right at the top we have VF, which comes in at 1, 2, and 3, and so that's a surprisingly strong performance across the three different categories. There's usually more variety, I think, than to come in first, second, and third. So that's a really respectable, strong performance from them.
And, when we look at VF versus Hanes Brands, we see a very different profile, in terms of averages and what they've been able to do year over year. However, if we look at the shorter term, Columbia Sportswear, which has done some great work in planning, Hanes Brands have actually come up the stack, and VF has been absorbing some of their acquisitions in the coalitions. Anything you see here?
Yeah, I think the apparel industry is one that can be hard to compare on sort of a large scale just because you have a Hanes Brands competing against a Ralph Lauren is probably not really a fair comparison. So again, being able to look at smaller peer groups more customized to what companies would consider their competitors is valuable, especially in this industry.
So kind of our winner circle of the companies that we see have made progress. These are the groups that, we see are making progress in their peer group. One of the things I think is really dangerous is to put all companies in a spreadsheet and shake them up. The other thing is to not be clear on improvement, right? This is a measure of improvement, not a measure of averages. We're looking at progress over time, and we're trying to answer the question for supply chain leaders of what drives progress in a balanced way. So in summary, what I'd like to share is we find that 9 out of 10 companies are stuck on the effective frontier of growth, profitability, cycles, and complexity. And that the traditional project approach of having an ROI versus alignment on a clear operating strategy has been detrimental. We've been working on really large projects, and we've thought that we have best practices. And I think we've got to rethink that to be able to drive balance and alignment and metrics. We see supply chain resiliency improving, which is this intersection for many companies and many industries. However, we see it increasing for contract manufacturing and 3PLs, which we think is an increasing risk for manufacturers. The index favors companies with high return on invested capital. We believe that supply chain leaders should return ROIC ranks that are higher than the market. And we also see that companies that have increased complexity, lost margin, and not fully utilizing assets are penalized in the rankings. So with that, Abby, what questions do we have from the group? Any questions?
I haven't seen any come in particularly.
Okay. Well, often, Abby, we get asked the question about resiliency and how we came up with that particular factor. You want to tell the group a little bit about that?
Yeah, we started graphing orbit charts, like I said, about 2 years ago, and we sort of threw all the metrics in and trial and error, went through, hundreds of different orbit charts, hundreds of different iterations to figure out, which patterns were meaningful and which metrics we thought made a good comparison point. And so that was just a process of trial and error and understanding that inventory turns and operating margin was really one of the most compelling intersections to look at, and it was most meaningful. So we were able to go to supply chain leaders and try to understand, this is what your pattern looks like, and what happened in 2007 that saw this huge jump in inventory turns, or, in 2009 you lost significant margin, what caused that?
And, we'll be glad to graph orbit charts or help people with their index. We give to companies, and hopefully they give back to us and tell us their stories. And we will be tying the supply chain index ratios into our financial data and quantitative data to be able to look at those particular trends. We will also be sharing the results on the final rankings of companies at our conference in September. And we will be asking for the Shaman Circle companies to be able to give their peer rankings. We really want to help drive supply chain of the future in a way that is balanced and aligned. And a lot of the work that we've done on the supply chain index for industries and the interviews that we've done with companies on their orbit charts are showcased in the book Metrics That Matter that publishes in fall 2014. And it actually looks at each of the value networks and their progress over the index and the effective frontier. Join us on our continued webinar series throughout the summer. Also hear from supply chain leaders as they talk about their ratios, about their journeys, and about their feelings about the supply chain index. We don't want to do this in isolation. We want to hear from you. We want to vet the ideas. We just think that we need to change the dialogue. Supply chain leaders need to be aligning, in our minds, processes and technologies with driving business value. So with that, this is Laura Ciceri I thank you for joining us. I look forward to hearing from you, and I also hope that you join us in our future webinar series throughout the summer. Thank you, Abby.
Thank you.